Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode 111, we're going to talk about the Rule of 55. We're going to look into early distributions from qualified retirement plans that you can receive penalty-free if you retire after reaching the age of 55. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, generally, it's well known that there's a 10% penalty tax that can apply if you take an early distribution from an IRA or from a qualified retirement plan like a 401k. So the cutoff for when that tax usually applies is age 59 and a half. If you take a distribution before age 59 and a half, then you're going to have to pay ordinary income tax on the distribution plus a 10% penalty tax on the taxable portion of that distribution as well. However, if you take the distribution on or after reaching the age of 59 and a half, there is no 10% penalty tax. There's just the ordinary income tax that applies. Now, there's a number of exceptions to the penalty tax. We've looked at a couple in past episodes, such as COVID relief distributions for 2020 and the new addition under the Secure Act, allowing for distributions for qualified birth or adoption expenses. But today we're going to look at the Rule of 55. Now, this rule might allow early distributions, but only from a qualified retirement plan and not from an IRA. So, what is the Rule of 55? The Rule of 55 allows you to start taking qualified retirement plan distributions if you retire after reaching the age of 55, and those distributions won't be subject to the 10% penalty. Now, the standard for being eligible here is not just reaching the age of 55, but also separation from service from your employer. Now, there's all sorts of nuances that we can dig into on what exactly separation from service means, but for what we're going to look at here, for all intents and purposes, the safe harbor is really that you completely terminate any sort of employment or service provider relationship with your employer. So, in other words, you don't stay on part-time, you don't drop your hours, you don't stay on as an independent contractor, you don't have any sort of arrangement where you're receiving money from your employer or property from your employer in exchange for the performance of services. So essentially, you need to retire or resign or even get fired. But there has to be a complete termination of any employment relationship going forward. And once you separate from service, the benefit is that you can start drawing from only the qualified retirement plan that's sponsored by the employer from which you separated from service. So once you retire, you can start drawing on your employer's 401k or 403a or 403b or whatever the case might be. But as I mentioned, this does not apply to IRA distributions. So there's a couple points I want to make there. One, this doesn't mean you can't start taking IRA distributions. In fact, with IRAs, even before you reach the age of 55, you can start taking early IRA distributions so long as you receive substantially equal distributions, at least annually, over your life expectancy or over the joint life expectancy of you and a designated beneficiary. Now, that's a subject for another time that has its own nuances we have to dig into, but one other thing I like to remind people of is the fact that if you have a qualified retirement plan through your employer, there may be a provision that allows you, after separating from service, and in fact this is the case in most cases, where you could roll over your 401k plan balance into an IRA, but if you do so, you might lose that benefit of the Rule of 55 because the Rule of 55 only applies to a qualified retirement plan and not to an IRA. So you don't want to make that rollover distribution. Now, another thing to keep in mind is that if you are also an equity owner in your employer, that kind of muddies the waters as well. So we're not going to get into the nuances of that either, but to be safe, you might want to divest yourself of your equity interest in your employer as well. Now, really, it's going to be the later of separation from service or the complete divestiture of your interest that really kind of starts the clock ticking on this if you truly want a safe harbor. Now, the good news is that retirement And commencing distributions generally will not start the clock running on required minimum distributions, because required minimum distributions are based on the later of reaching age 72 or retirement, unless you're a 5% or greater owner of your employer, in which case it's just age 72. So prior to age 72, you're free to take out as much or as little as you want on a year-over-year basis from a qualified retirement plan, subject to the penalty tax. But as we're looking at here, there is a waiver for that. It's only once you hit age 72 that you have to start drawing from it year over year. Now, when it comes to reporting, your plan administrator or plan sponsor will issue IRS Form 1099-R to you, and the distribution amounts should be included on lines 5A and 5B of your Form 1040. You'll have the distribution amount in 5A and the taxable amount in 5B. Generally, those are going to be the same, just because there's really no basis in a qualified retirement plan. But I do want you to note the distribution codes in box 7. Now, your employer or plan sponsor should know that you're age 55 and should know that you've retired, so code 2 should be entered, showing that the employer knows there's an exception to the early distribution penalty. However, if 1 is instead entered in this box, you may need to go back and request an amended 1099-R, because what the code of 1 says is that your employer doesn't know of any exception to the early distribution penalty, and that's being reported to the IRS. So if you can't get an amended 1099-R to correct that box 7 to the code of 2, you may have to file IRS Form 5239. And in doing so, you'll have to note the accepted early distributions on Part 1, Line 2 of that form, and enter code 01 on the box for that line, and submit it with your Form 1040. Now, even if you get an amended 1099-R, it may be helpful to go ahead and file the Form 5239 just to avoid any red flags going up with the IRS if they see the original 1099-R before the amendment. But either way, what this does is it results in you being taxed on the distribution, but not having the additional 10% penalty tax. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.